investor friends, I'm Michelle Markey, and today I'm going to talk about the question, should you copy Warren Buffett? And to me, this kind of question shouldn't even be up for debate based on the cold hard facts I'm going to take you through in this video. And as always, it would mean a ton to me if you could please smash that like button and please subscribe for the YouTube algorithm, because I'm trying to help you and myself be the best investors we can be, and I greatly appreciate it. Thanks. A lot of times in investing, investors feel happy and lucky if we can manage to get 10x or 100x on our investments, which would be a 10 bagger and a 100 bagger respectively. But if we were so lucky to have invested in Berkshire Hathaway in the early 1960s, we would have had a multi-thousand bagger in which the Berkshire Hathaway A shares rose from around $8 in 1962 to a high of $439,000 a share in 2021, with exponential growth, much like a hockey stick. So I don't know about you, but I kind of wish I was alive in the 1960s to be able to take advantage of investing in such an incredible company. And pretty much no other company's performance can compare to Berkshire Hathaway's long-term investment track record. And to put the power of compounding in perspective, Berkshire Hathaway from 1965 through 2020 generated compounded annual rate of returns of 20% compared to the S&P 500's 10.2% over the same 55 years. So what this means is if you had invested $10,000 in Berkshire Hathaway in 1965, you would have generated 2,800,000%, or $281 million from a $10,000 investment. And this compares to a return of 23,500% for the S&P 500, or $2.36 million. So between the two of those, I would rather have amassed almost $300 million compared to $2.33 million with the S&P 500 just by going with Berkshire Hathaway back in 1965. And while I wasn't alive back in 1965, you know how they say hindsight is 20/20, and the sunset is rising just like the Dark Knight rises. And I believe that we can trust and learn from Warren Buffett, but not just blindly copying like the sun is about to do to my face. So let me go close some blinds. Much better, right? So this naturally begs the question, why not copy Warren Buffett? And we could all look at his institutional filing that's required by the Securities and Exchange Commission, or SEC, where institutional money managers like Buffett have to file what's called a 13F quarterly report in which they disclose their holdings. And this could be what they're generally long with in their equities, and also shows some of their puts and calls, but doesn't show their short positions or international holdings. So with that being said, these 13F forms come out up to 45 days after the close of a quarter. So we could already be in the middle of the next quarter before we find out what some famous investors who have at least $100 million of assets under management have their holdings in. But nonetheless, this could still be a gold mine, as this Reddit thread talks about, where sometimes you could find some good ideas, and based on this anecdotal evidence only, I mean, obviously we have to do our own research, but there could be some potential ideas that are worth considering as potential investments that we might like to make. And if you're on a quest for the answer, surfing the internets like I was, you might come across feedback on places like on Quora, where someone asked the question, what if everybody copied Warren Buffett's stock portfolio? To which there was a sassy response from Doug in which he said, why don't more investors copy Warren Buffett? And he said that most investors do the opposite and are surprised when they get the opposite of what Warren Buffett has been able to achieve. But then there's also some fair questions like, can Warren Buffett still beat the market? And by market, we're usually referring to the S&P 500. And lately in recent years, like I'm talking from 2018 through 2021, it looks like Berkshire Hathaway has been a little bit underperforming the S&P 500, because it seems like Berkshire has been returning maybe around 12% compared to the S&P 500's average of around 15.7% from what I calculated. So although there's been a little bit of underperformance in recent years, I still think for the long term, Berkshire Hathaway could be really strong, but none of this is investing advice. You got to do your own due diligence and see what makes sense for you. While the internet is busy debating this question, like if we do a YouTube search, scrolling down the results of a bunch of naysayers, except for Monish Pabrai and Phil Town, Warren Buffett is busy cloning himself and buying back Berkshire Hathaway shares to the tune of $25 billion in 2020. And then so far in 2021, it looks like he might have bought back $12 billion in the first half of 2021. So he's wasting no time in buying back Berkshire Hathaway shares. So if Berkshire is good enough for Buffett, why isn't it good enough for a lot of other investors? It makes you think. And if that's not evidence enough, what I believe could be strong evidence to warrant for potentially copying Warren Buffett is this study called Imitation is the Sincerest Form of Flattery, Warren Buffett and Berkshire Hathaway, that was originally published in 2005 and updated in 2008 by Martin and Puthan Porakal. And in this study, they found that his portfolio was often invested in sort of large cap growth rather than what we traditionally think of as value stocks, as well as if you invested in the same equity portfolio as Warren Buffett from 1976 through 2006, you outperformed the S&P 500 by 11.14%. And then if you mimicked his portfolio in which you only invested a month after these holdings were publicly disclosed of the equities in Berkshire Hathaway, you still beat the S&P 500 by 10.75%. So with that being said, this study is really fascinating to consider, and I'll go through a few more interesting things I found out from it. And the authors found that Berkshire Hathaway's equity portfolio was concentrated in relatively few stocks where the top 5 holdings averaged 73% of the portfolio's value. And then the study included this chart showing cumulative returns from 1976 through 2006. And I added some imagery to spice up this sort of black and white chart. And as we can see, there's no question that Berkshire Hathaway A shares performed the best, followed by Berkshire Hathaway's equity holdings that included the likes of Apple and American Express and Coca-Cola. But maybe Apple wasn't among them back then, so never mind that one. But in general, you catch my drift. And then you can see that if we were copycat investors, we performed almost just as well as the equity portfolio. So that was pretty good. And then compare this to the S&P 500's performance at the bottom, and you can see that they were just a sort of snail-paced linear grower as opposed to the exponential grower that is Berkshire Hathaway A shares. To back up what's shown in that chart, the following table shows the performance of Berkshire Hathaway and its equity holdings and a mimic copycat portfolio, as well as compared to the S&P 500. And we can see here that if we had just stuck with Berkshire Hathaway, we would have had a cumulative return from 1976 through 2006 of 943%, which averages to 30.43% annualized. And then we get a total return for the equity portfolio of 774%, and its average annualized rate of return is 24.97%, and just 0.39% less than that average rate of return is the mimicking copycat portfolio of 24.58%, or a total cumulative return of 762%. And this all compares to the S&P 500's sort of middle of the road total cumulative return of 429% and their average annualized rate of return of 13.83%. So hands down, if we had just invested in Berkshire Hathaway over those 30 years from 1976 through 2006, we would have beaten the S&P 500 by a long shot. And if you're wondering what could be some of the reasons for this outperformance, people like Larry Swedroe have said that it's because Buffett is buying cheap companies that are of very high quality, and that they also happen to have a low debt to equity ratio and low earnings volatility, high margins, and high asset turnover, which just means that they're using the assets very efficiently to generate revenue. So if this is the kind of company that Warren Buffett seeks to add to the conglomerate that is Berkshire Hathaway, then he's doing a pretty good job of it, because it's even beating the equity holdings that Berkshire Hathaway owns. Along your journey on the internets, you could also come across a bunch of faceless naysayers who say that you can't replicate what Warren Buffett has done, and that even though he bought Coca-Cola when it was worth next to nothing, I think that we can still buy stocks that might not be Coca-Cola, but could be other undervalued stocks if we really try to do our homework and research and we believe in the future of a certain company and it has a durable competitive advantage, or also known as its moat. And then that aside, I took a bunch of these faceless naysayers' arguments and I put them into two tables and I put my rebuttals to each and every one of their arguments. So feel free to check out my part 1 where you can read through all this, because if I read through it, I would be taking up way too much time in this video. So I want you to study this if you take these ideas seriously. And then I also have a part 2. And again, I wouldn't want to go through each and every one of these rebuttals to each of their arguments, but feel free to read through and pause at the video so you can learn what I've said. One of these naysayers' arguments that I do want to talk through a little bit is that when they said that he wasn't busy planning for retirement or an annual vacation, and to that I say he didn't have to. He reached financial independence and was able to retire early at an early age. Like supposedly when he was 30, he hit $1 million. And as we know nowadays, his net worth is probably around $100 billion. But that aside, if he was at age 30 a millionaire, back in those days, that would have been equal to $9.2 million in 2021 terms. And if we discount inflation again to see what he really would have been as a millionaire, even at $140,000 back in 1956, that was still already $1.4 million worth. So we have to go back to when he was 25 in 1955, where he had $100,000 and that was equal to $1 million in today's terms. The evidence I've presented so far would have us believe that maybe Berkshire Hathaway is a pretty good long-term stock to potentially invest in. And if we can't afford the $400,000 A share, maybe we might want to buy the $200 to $300 B share. And if that's not affordable enough, there could be potentially fractional shares that we might consider investing in to some extent if we believe in Berkshire as a business. And if you don't understand the business, don't force it. It might not be the right investment despite its historical rate of returns. And by the way, it's not like even though it's performed well to date that it's always guaranteed to perform well into the future. So that's one thing to keep in mind. And not to mention, Berkshire Hathaway as a stock might not even be on sale right now. So even though Buffett might be buying back its shares, it might not be the best value for us to buy right now. So definitely do your homework and see what price makes sense for us to potentially buy Berkshire Hathaway if you believe in that company. As well as in another Buffett and Batman analogy, we can think of Buffett as a sort of Batman where he focuses on concentrating a large amount of Berkshire's money in its top holdings. So if we look at that, we can start with the top 5 holdings of Berkshire Hathaway and see if we might want to invest in some of the same companies, including ones like Apple or American Express. And then we can go down the line and see what Robin is investing in, or maybe Ted and Todd, who are the sidekick investors to Buffett, and see what kind of picks that they have that amount to less than 1% of the portfolio's holdings. And we can see if we might fancy investing in any of those companies. And then if we run out of ideas out of these 40 to 50 stocks, then we might want to hop on over to Charlie Munger or maybe Alfred's portfolio, in which he's investing in only 5 companies in the Daily Journal Corporation's portfolio. So with that being said, this might give us some food for thought into potential investments we might want to copy from some of these legendary, greatest of all time investors. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be. Till next time.